Don't get me wrong. I do understand the common narrative. I do understand what everybody else is saying, that time in the market beats timing the market. So say for the S&P 500 for buying stocks, just buy a bit every month and hold this over many, many years, and you should be ahead long term. That's the common narrative, but that's only true if our time horizon is, say, 20, 30, 40 years. That's not necessarily true if our time horizon is maybe only 5 years or 10 years. Have a look at this here. That's the Shiller PE ratio, the price to earnings ratio of the S&P 500. How expensive is the stock market right now? How many forward earnings are we paying? We have to wait 40 years with the current earnings to get our money back. 40 years. And last time we had been at a similar level. At the height of the dot-com bubble, we subsequently saw that crash, and then afterwards another crash, the global financial crisis. So the advice of just buying and holding over the course of those 9 years, it wasn't necessarily great. How much did the stock market fall from that top over here to that bottom over here? The answer is 55%. But of course we can fight against that decline, again with just buying into the market regularly every month. And that's the common narrative. And it's a narrative that makes sense. Let's say you bought $1,000 into the index over those 9 years every single month. You would have invested $108,000. There's a bit more here because I also included some trading fees. Your final value would come out as $82,000 roughly. So the total return over that time period is minus 24%. Not minus 55, but only minus 24%. This doesn't look that bad, given that we have cherry-picked the worst time to start investing, worst time to end investing. Not great, we still have lost money, but minus 24% isn't going to break anyone's neck. And so I do understand the argument. Very long-term stocks go up, and that's actually mainly because of monetary debasement. It's mainly because there's more and more dollars floating around. So keeping your money just in cash is wrong. But also having realistic expectations of stock market returns going from here, when valuations are already that high, is also important. Most people think that when you buy the S&P 500 long term, even if you start today, you can expect roughly 10% per annum. But I don't think that's true. Our return expectations have to be much more modest, and that's based on this analysis here. We're going to discuss this analysis in this video. What you're seeing here is how much past performance is correlated with future performance. So if in the past we had a very good performance, we tend to have lower performance going forward. If we had very poor performance in the past, we tend to have higher performance in the future. This makes sense, right? If we buy more during a market crash, we tend to get higher performance subsequently. If we buy after a rally, and when everybody talks about stocks, when everybody talks about the particular asset class, it can also be crypto, it can also be gold. When something has already rallied quite a bit, probably the future returns won't be as high. And that's what this chart here is showing. And we're going to dive deeper into the data. How much lower is the return going to be if you've already rallied? What's the expected return, say, for the S&P 500 from now, given this data here? So this all comes from Bitcoin Strategy Analytics, the backtesting platform available to the premium members of this channel. This is the return autocorrelation mode. And we are backtesting the S&P 500 over time. And as a start date, we are using the beginning of the 1960s. That's also when the Federal Reserve has become much more active in its policies. That's also when money printing started to accelerate. Now here's the first of such analyses. What we're seeing in this chart is how is yesterday's performance correlated with tomorrow's performance. So let's say yesterday we went down by 10%. Are we more likely to go up tomorrow? Or are we more likely to go down by another 10% tomorrow? So you just look at yesterday compared to tomorrow. 1 day versus 1 day. And this shows clearly that the connection between yesterday's performance and tomorrow's performance isn't really that strong. We've got a big bubble of data points there tends to be a slight negative correlation. So there is negative slope in this line, but the R squared is very, very low. In other words, the regression line that we see in orange is not very representative of the data points. The connection is extremely weak. So maybe we shouldn't look at yesterday versus tomorrow. Maybe you should look at last week's performance versus next week's performance. Then we're getting this chart. Now we can already see how there's less outliers and how the slope is a bit stronger and how the R squared is also going up. So the R squared before was 0.00147. And if you look at last week versus next week's, it's 0.002227. The R squared simply measures how well does the line represent the data points. If all of the data points are directly on the regression line, then we've got an R squared of 1. So the line perfectly represents the data points. The lower the R squared, the more random the data set is, and the less the line can represent the data points. In other words, with a low R squared, we can't really expect to make a good prediction about tomorrow's return based on yesterday's return. And so that's why it might make sense to optimize the time window, right? We've already seen how yesterday's performance doesn't impact tomorrow's performance much. We have seen how last week's performance impacts next week's performance a bit more. What about, let's say, last month, next month? And so this chart here shows now where we've got the highest R squared. Should we look at last year versus next year? Should we look at the last 10 years versus the next 10 years? This here is the answer. So on the x-axis, we've got the R squared. On the y-axis, we've got the backward and forward looking window. And the ideal point is here. It's at 4,350 trading days. That's 17 years and 16 weeks. And that's then where we get this chart. Now the line represents the data points quite well. Now we get a pretty strong connection between prior return and future return. And now we can dare to make a prediction about stock market returns based on that model. We just have to look at the performance in the last 17 years or so, and then we get the point on that line to see the future performance. Of course, there will be some error. This is not perfect. There are some data points that are way lower and some that are higher, but it is a relatively strong fit. The fit is an R squared of 0.88. In other words, 88% of the price movements can be explained just by this regression line. So let's have a look at the numbers. What happened in the last 17 years and 16 weeks for the S&P 500? We made 690% simple return. That translates into 206% return logarithmically. So we are using logarithmic returns here. That's a mathematical trick to make the regression work a bit better. It makes the analysis more precise. And when we take that return and we check what's then our predicted forward return, the log return is 72%. The simple return is 107%. So 107% expected return over the course of more than 17 years. In the year 2043, the S&P 500 would hit roughly 15,000 points. And that's based on a model that historically predicted the S&P's returns quite well. This means annualized, we are looking at 4.3% per annum. Every year, on average, the S&P 500 would only return 4.3%. That's how much those high valuations impact stock market returns. Again, over almost 2 decades. Let's say you invested at the height of the .com bubble and then you held the S&P 500 for 17 years. You would have made only 51% return. So our model is even more optimistic compared to buying at the exact tip top of the market. If you bought at the top in 2007 and then you held for 17 years, you'd be up 175%. So our model is representing pretty well what the S&P 500 has done in the past in similar situations as well. Now, 4.3% per annum is not negative, right? It's still better to hold the S&P 500 over just being in cash. And we don't really know when the crash happens or if it will happen at all. We might as well just go sideways for many, many years and not make any gains. This is something that happened in the past. Have a look at, say, 1965 until 1982, 17 years of data, 10% of gains without any major crashes. That's then how that looks like on the S&P 500 over time, right? We would still go up. This would be our data point. This here is 17 years and we'd be around here. But of course, we can't know how we are getting there. If we see a crash and then a massive rally and then we go this way, or if we continue to rally and then maybe we crash down to that data point, who knows how we're going to that point. And of course, in the end, this is also still just a model, right? We don't really know how well this will work in the past. But it is a model that historically explained the price movements for the stock market quite well. When people say that prior performance does not matter at all for future performance, I don't think that's true. It's better to buy stocks after a crash. And that should be obvious, right, when we think about this. When the S&P 500 crashed by 50%, 60%, 70%, of course we should buy more compared to when it just hit the all-time high. At the all-time high, we are much more likely to buy expensive. The money devalues by 6.8% per annum. That's how quickly US M2, the M2 money supply, grows over time. And that's really the fundamental reason why the S&P 500 goes up long term. When we look at the S&P 500 relative to the money supply, and again, there's a long-term chart that starts in 1959, we don't necessarily see the stock market outperforming the devaluation that much. And again, we are at a historically high point. I'm not saying we have to crash down from here. I'm just saying that historically, over the last 60 years, the stock market was never as expensive compared to the dollars that are floating around right now, ever in its history where we measured the money supply. So we've got our expected 4.3% per annum over the next 17 years based on this chart here. And we've got a monetary devaluation of 6.8% per annum. So really, in purchasing power, we are losing over the next 17 years if the model holds. How much are we losing? How much does this compound? The answer is 36%. And that's then how the chart would look over time. Again, we don't know how we're getting there. If we just go sideways in the S&P 500 while the money supply devalues, or if we suddenly see the AI bubble popping and then things recovering again, or if we see a continuation of the bubble and then we crash down. I do not know. I just see that this is our long-term expected return up until the year 2044. And so what I take from this is that the easy solution that we had over the last 20 or 30 years is not necessarily the right solution over the next 20 years. It might be the right solution for the next 40 years, but the question is your time horizon really that long? If you're currently 20 years old and you plan to retire, say, when you're 60, then it might make sense to just continue to stupidly buy in the S&P 500 and set and forget. But if you're currently, say, in your 40s, you consider to retire in your 60s, or maybe you only have 10 more years left until retirement. Maybe it makes sense to look at other asset classes that aren't historically as expensive. There's many options, right? We can dollar cost average in many things that go up long-term over time. Gold also appreciates long-term over time. The property market also appreciates long-term over time. There are many ways to escape the debasement of the US dollar or the debasement of any fiat currency for that matter. We don't necessarily have to be forced to put 100% of our savings in the S&P 500 when the Shiller PE ratio is that high and when historically, quite reliably, future performance was negatively correlated with past performance. And the past performance, unfortunately, was quite high. And so future performance should rather be low. This analysis, by the way, was done with Bitcoin Strategy Analytics. That's the backtesting platform available to the premium members. There's not just return autocorrelation, there's all kinds of backtesting methods, how we can potentially even use technical indicators to time the market, how we can optimize leverage if we want to go more risk on, how a backtest works over time, as in we use rolling windows, figure out how a trading will work. I'm sharing my personal trading approaches here as well, together of course with how I currently set up my portfolio. If you got some value out of this video, feel free to give it a like, it helps the channel grow. Feel free to also subscribe. I publish videos regularly. See you next time on YouTube or see you in premium. Cheers!